Welcome back to another episode of the Tip Share. This week, I'm excited to bring you unbeatable prime cost control strategies to increase your restaurant profits in 2022. Let's get started. Some of you might be asking, what is prime costs? Your prime costs is inclusive of your largest expenses. This includes your cost of goods, your food and beverage, and labor expenses, including payroll taxes. These are the first two categories you're going to find on your restaurant's profit and loss statement. Prime costs can be calculated with the following formula. Total cost of goods plus total labor is going to give you prime costs. Now let's break that down even further. COGS is the acronym that stands for cost of goods or cost of sales depending on your restaurant. Same thing. Cost of goods is the first prime cost area you're going to see on your restaurant's P&L. And just to take this a step back, let's remember how to calculate cost of goods. It's going to be your opening inventory plus your purchases minus your credits minus your ending inventory, all divided by sales. That's going to give you your cost of goods. Second is labor. This is the largest expense area for most restaurants, and it's the second and final prime cost area on your restaurant's profit and loss. Your total labor includes your operational labor, so your front of house and back of house hourly employees, plus the remainder of your labor. This is your salaried employees, payroll taxes, employee benefits, and employee discounts. Prime cost as a percentage of sales is a number that helps you determine where your prime costs fits within the restaurant industry average. More importantly, however, this helps you to compare against your own historical data to ensure you're making progress over time and maximizing profits. Prime cost as a percentage of sales is simply your prime costs divided by your total sales. Now you might be asking, what is the restaurant or hospitality industry average for prime cost as a percentage of sales? This will typically range between 60 and 70% of your sales, the lesser end of the range being your ideal target. Now let's remember, if costs are 60 to 70%, that leaves you with 30 to 40% to flow down to other costs associated with your restaurant, such as supplies, maintenance, and occupancy. Keep in mind, though, that this range can vary greatly between quick service restaurants and full service restaurants. So, why is it important to control prime costs? It's important for operators to control their prime costs because cost of goods and labor are the largest expenses to the restaurant. If you're lowering prime costs, then you're positively impacting your bottom line. Prime costs can fluctuate greatly depending on what's happening around the globe. Commodity prices, staffing challenges, and consumer behavior can all affect your prime costs. Therefore, the more frequently you review your prime costs, and financial statements for that matter, the better. We recommend a weekly manager meeting to review your restaurant's P&L for this exact reason. This is why operators have the most direct control over these areas. Consistently assessing your data makes certain that you're better equipped to make educated business decisions based on opportunities presented in your analysis. So, how exactly do we control prime costs? We have 3 strategies for you to do this. Our number 1 strategy is going to be review and forecast labor and then schedule accordingly. Getting control of your labor dollars can feel like a daunting task, especially when you're facing industry-wide labor shortages. When reviewing labor, best practices include to review period trends. Analyze your last 3 periods, look at your overall labor costs, and see if you can identify any trends. The next one will be reviewing historical trends. Analyze year-over-year trends to highlight even more areas of opportunity. Note, it's critical to understand what took place at the time of your trend comparisons. Holidays, parties, seasonality, and weather, these all can have an impact. This will help paint the picture in the long run so you can understand if you're comparing apples to apples or apples to oranges. So, what tools can I use to execute on this strategy? So, the Sales and Labor Analysis Report is a great place to start. Using tools like a SLA report or a sales and labor analysis is going to help provide you with key metrics to better understand what you're currently doing in sales and labor compared to what you forecasted in those areas. For an even more full description on all of the tools that I'm going to mention for strategies 1, 2, and 3, go look at the full blog post for an even more in-depth understanding. Strategy 2 is going to be taking control of your inventory and optimizing your menu. Counting inventory is the best way to get an accurate representation of what your true usage is. Furthermore, counting inventory is going to enable you to perform preventative maintenance checks. Lastly, doing inventory counting is going to help keep a tighter control on waste, error, portioning, and theft that may be occurring in your restaurant. What tools can help you manage inventory and optimize your menu? Right off the bat, the weekly spend forecast. Just like the name reflects, a weekly spend forecast puts you in a position to evaluate and optimize daily spending. Check out our declining budget blog to learn more about how you can stabilize your costs and increase your cash flow. Another tool that's going to help you take control of your inventory and optimize your menu is menu item velocity reporting. Menu item velocity reporting shows daily operational data that identifies volume of sales per menu item or category. You can then view which items have positive sales and positive contribution margin to optimize profitably within your menu. The last tool that you're going to be able to use here is the COGS audit report. In a restaurant, COGS is where managers can make the most impact. When analyzing COGS, you're looking at your big ticket items, anything that's significant in getting food to the customers. Strategy number 3 is going to be leverage relationships with your vendors. Building relationships with all of your reps from food and beverage vendors can help you maximize savings. Creating a partnership for your restaurant and your vendors is key to deepening your level of engagement. This enables you both to strategize together. It's crucial that you prepare before you sit down with your key vendor partners. Make sure you're knowledgeable about purchasing trends and price volatility. This way, you can ask about applicable programs or discounts that are specific to your goal and what you need. Tools that are going to help you leverage relationships with your vendors are going to be invoice analysis tools. This enables you to track key inventory price changes and quantities purchased over time. Utilizing this type of tool provides you with data to speak intelligently with your vendor partners about various strategies for your franchise players. Examples include the possibility of product substitutions, recipe enhancements, or raising menu prices. Another strategy could be a manufacturer rebate program. If you're currently not involved in any manufacturer rebate programs, then you might be missing some cost savings that could help you decrease your overall costs. Manufacturer rebate program leverages the purchasing power of all its members to negotiate contracts with suppliers. Thanks so much for tuning into this week's episode of the Tip Share. We hope you enjoyed the unbeatable prime cost control strategies to increase your profits in 2022 and beyond. We'll be back next week with another episode. Until then, take care.